Imagine an economy so large it produces more steel, cement, and skyscrapers than the rest of the world combined. And right now, that economy is sitting on a financial time bomb that most people have never even heard of. If it goes off, your savings, your investments, your country's economy, none of them will be untouched. What's up, everyone? Welcome back to Money Science AR. I'm your host, and today we're breaking down one of the most complex, misunderstood, and genuinely dangerous financial stories of our era: China's debt crisis. We're talking about a $50 trillion debt machine, with a collapsing real estate sector that used to be 25% of the entire economy, shadow banks operating in the dark, and local governments hiding debts so large they dwarf the GDP of most countries on Earth. And here's the scary part. Most Western investors and everyday people are completely unaware of what's building beneath the surface. By the end of this video, you will understand how this crisis started, why it matters to you, even if you've never invested a single dollar in China, and what the real endgame scenarios look like. Let's get into the science of money. The property bomb. How did China's real estate get so big? To understand the crisis, you need to understand how China built its economy for the last 3 decades. The formula was simple on paper: build, build, build. Local governments in China couldn't run budget deficits the traditional way, so instead, they sold land to developers. Developers borrowed massive amounts of money, built apartments and commercial districts, and sold them. Often before a single brick was laid, buyers would put money down on homes that existed only on blueprints. This pre-sale model worked brilliantly when prices were rising. Developers collected buyer cash, used it to start new projects, borrowed more, sold more. It was a machine running at full speed. At its peak, China's real estate sector accounted for roughly 25% of GDP. To put that in perspective, in the United States, real estate is about 16 to 18% of GDP. China's was dangerously higher. Then in 2020, Beijing pulled the emergency brake. They introduced what's called the 3 red lines policy, strict limits on how much debt property developers could carry, a liability to asset ratio below 70%, net debt to equity below 100%, and cash must cover at least their short-term debt. For a massively over-leveraged developer like Evergrande, which had borrowed more than $300 billion, this was a death sentence. By 2021, Evergrande began defaulting on its obligations to suppliers, to creditors, to the ordinary Chinese people who had paid for apartments that would never be finished. Home buyers staged mortgage boycotts, refusing to pay loans on ghost buildings. The crisis was suddenly very human. Fast forward to today, and the situation has only deepened. More than 60 major Chinese property developers have defaulted on offshore debt or entered restructuring. Evergrande was delisted. Country Garden, once the largest developer in China, is sitting on $190 billion in debt restructuring negotiations. By mid-2025, over 40% of major developers were flagged as high or severe risk, with default probabilities exceeding 20%. About half of all stalled construction projects across China remain unfinished. The sector's debt-to-GDP ratio, it now exceeds 250%, and there are $375 billion in US dollar-denominated bonds, meaning this debt isn't just China's problem, it's a global problem. Now here's where it gets really interesting and really dangerous. Most people think of banking as straightforward. You deposit money, a bank lends it out, it earns interest. But China has an entire parallel financial universe operating alongside that traditional system. This is shadow banking. In China, shadow banking takes several forms. Wealth management products, WMPs, are investment products sold by banks that promise higher returns than regular savings accounts. Trust products, which pool investor money and lend it to riskier borrowers. And entrusted loans between companies, bypassing banks entirely. At its peak, China's shadow banking system was worth somewhere between $3 trillion at the narrowest definition, and up to $12 or $13 trillion if you include all asset management and consumer lending products. That's larger than the entire German economy. Here's the terrifying feedback loop that was created. Property developers like Evergrande used wealth management products to raise money from ordinary Chinese investors. many of whom were retirees looking for better returns than a savings account. These WMPs were often sold through state-owned banks, which made investors assume they had an implicit government guarantee. They did not. Developers used that investor cash to fund new projects. New projects generated revenue. Revenue was used to issue even more WMPs. The whole machine depended on prices rising and new buyers appearing. When that stopped, the loop broke. Zhongji Enterprise Group was one of China's largest shadow banks, managing hundreds of billions in assets with deep ties to the property sector. When property markets collapsed, Zhongji collapsed with it. In January 2024, it filed for bankruptcy, one of the largest financial collapses in Chinese history. Trust companies across China followed. Zhongrong International Trust, which had invested in Evergrande, Sunac China, and other failed developers, began missing payments. Wangxiang Trust, with 58% of its assets tied to real estate, faced severe distress. And here's what makes this more frightening. Due to the opacity of these institutions, nobody, not even Chinese regulators, knows the full scale of exposure. Now let's add a third layer to this story, and this might be the most dangerous layer of all. Because Chinese local governments couldn't borrow money directly, that was prohibited under fiscal reform laws, they created workarounds called local government financing vehicles, or LGFVs. These are essentially companies owned by local governments that could issue bonds and take out loans, using land as collateral. LGFVs funded everything: roads, bridges, schools, stadiums, entire new city districts. Sounds fine, right? Until you realize that the revenue to pay back those bonds was supposed to come from land sales, and land sales have collapsed along with property prices. The IMF reported that China's local government debt reached $12.9 trillion in 2022, up 50% from just 2019, and that's only the official figure. The hidden debt, the off-balance sheet liabilities sitting inside LGFVs and shadow banking vehicles, could amount to another $10 trillion. Some estimates put total local government hidden debt at $14 trillion or more. When property prices fall, land sale revenues dry up. Local governments in China relied on those revenues for up to 40% of their budgets. With that gone, they can't pay contractors, can't fund basic services, and can't service their LGFV debt, much of which was raised through the very shadow banking system we just described. You see how these three systems, real estate, shadow banking, and local government debt, are completely intertwined? Pull one thread and the whole fabric starts to unravel. Why should you care? Here's the question I know you're thinking. I don't live in China. I don't own Chinese property. Why does this matter to me? Let me give you 5 concrete channels through which this crisis reaches your doorstep. Chinese property developers issued more than $300 billion worth of debt to foreign creditors, US and European banks, hedge funds, sovereign wealth funds. Country Garden alone caused bondholder losses of over $10 billion. When these bonds default, the losses land on global portfolios, pension funds, ETFs, investment vehicles that millions of ordinary people hold without knowing it. China consumes more than half the world's iron ore and is the world's largest importer of copper. It drives demand for Australian coal, Brazilian soybeans, Middle Eastern oil. When Chinese construction freezes, commodity prices fall. Resource-dependent economies from Australia to Brazil to Saudi Arabia feel the impact in their trade revenues and national budgets. A weakening Chinese economy buys less from everyone. European luxury goods exports to China have already slowed. Asian electronics manufacturers that supply Chinese factories feel reduced orders. The ripple goes everywhere. Markets are built on confidence. When investors globally see a $12 trillion shadow banking system under stress, with unclear government backing, with hidden debt nobody can fully measure, risk appetite drops worldwide. Investors retreat to safety. Emerging markets suffer capital outflows. Interest rates in other countries can spike. Beijing is under pressure to let the yuan weaken, a tactic to make Chinese exports cheaper and offset the economic damage. But a significant devaluation of the yuan shakes Asian currency markets, increases China's USD-denominated debt burden, and puts pressure on countries that compete with Chinese exports. A 10% devaluation could slash roughly $900 billion off the real value of domestic debt, but it creates enormous instability internationally. Economists estimate a severe Chinese debt crisis could reduce global GDP growth by 0.5 to 1 full percentage point. That sounds small until you realize 1 percentage point of world GDP is over $1 trillion. Is this China's Lehman moment? Everyone wants to know, is China headed for its own Lehman Brothers collapse? Its own 2008? The answer, based on the best available analysis right now, is probably not exactly, but that doesn't mean we're safe. China's government has enormous levers it can pull. The state controls the major banks. It can order banks to roll over bad loans, extend debt maturities, and avoid triggering formal defaults. It has $3.2 trillion in foreign exchange reserves to deploy. The capital account is not fully open, meaning contagion is somewhat contained by the architecture of the system itself. Furthermore, shadow banks, while enormous, are still a minority share of total banking system assets. They're unlikely alone to trigger a full banking system collapse. But here's the thing. What Beijing is doing by rolling over bad loans and suppressing defaults is not solving the problem. It's deferring it. The debt doesn't disappear, it accumulates. Interest accrues. Non-performing loan ratios in Chinese banks are forecast to rise to 5.4 to 5.8% by 2027, up from already elevated levels. The longer the property sector stays depressed, the larger those losses grow. And the longer consumer confidence remains crushed, because 70% of Chinese household wealth is stored in property, the harder it becomes to generate the domestic demand growth the economy desperately needs. GDP growth slowed to 4.7% in Q1 of 2025, below the government's own 5% target. Consumer prices were barely above zero. Youth unemployment remains a significant social pressure point. The risk isn't necessarily a sudden collapse. It's a long, grinding deterioration, a Japanese-style lost decades scenario that slowly suffocates growth, erodes confidence, and compounds pressure on the global system year after year. What should investors do? This is Money Science AR, so let's talk about what this means practically for how you think about your money. 1. Understand your exposure. Check whether your index funds or ETFs have significant allocations to Chinese equities or emerging market bonds. Many passive investors are unknowingly exposed through broad EM funds. Knowing your exposure is step 1. 2. Diversify commodity exposure. If you hold positions in commodity-heavy sectors, mining, steel, energy, understand that a prolonged Chinese slowdown is a structural headwind for those assets. That doesn't mean sell everything. It means price the risk accurately. Beijing's policy response is the key variable. Watch for central government bond issuances to recapitalize banks, PBOC rate cuts and liquidity injections, official stimulus packages targeting infrastructure and consumer spending, and any changes to the LGFV debt restructuring framework. These moves are your leading indicators. The smart investor doesn't predict the future. They prepare for multiple futures. Scenario 1, manage slowdown, gradual restructuring. China avoids full crisis. Global impact is moderate. Scenario 2, policy misstep or external shock accelerates defaults. Financial contagion becomes severe. Global growth takes a significant hit. Scenario 3, prolonged stagnation, weak demand, steady commodity pressure, slow bleed rather than dramatic collapse. A resilient portfolio accounts for all three, not just the one you hope for. Here's the bottom line. China's debt crisis is not a distant problem. It's not just a headline. It is a $50 trillion experiment in debt-fueled growth that is now confronting the bill. Real estate built the economy. Shadow banking financed the risk. Local governments hid the liabilities. And now all three are interconnected in a way that makes the unraveling slow, complex, and genuinely dangerous to global stability. The purpose of this video isn't to scare you. The purpose, as always here, is to arm you with the knowledge that most people simply don't have. Because understanding the science of money means understanding not just the opportunities, but the risks. If you found this breakdown valuable, please hit the like button. It genuinely helps more people find content like this. Subscribe if you're not already part of the community, and drop a comment below. What do you think? Is China heading for a crash, or will Beijing manage its way through? I'd love to hear your perspective. Until next time, stay curious, stay informed, and keep studying the science of money. This has been Money Science AR. I'll see you in the next one.